Josh, officially welcome to the Wealth Juice podcast. We are so excited to have you on the show. I think this actually might be the second round of interviews that we've had you on the show for, or the second interview, I should say. But we are so excited to have you here. You're a wealth of knowledge, and I want to dive into your personal story today. So thanks for being here.
I'm glad I passed the test the first time, and I'm glad to be back. Let's roll.
Yeah, man. This is going to be awesome. So let's take a quick walk down memory lane here and give us a breakdown of who you are, where you're from, and then what you do professionally today.
Yeah. So, I had an interesting childhood, an interesting relationship with money that in the rearview mirror, I was super grateful for. But as I was going through that experience, it was really kind of a scary experience. I was raised by a single mother. My mom and dad were divorced before I was born. And I grew up in LA. It was not the glamorous Hollywood side of LA. It was the rough side of LA. And, the reality was we were in and out of the welfare system my entire childhood. And I was fascinated. I had this like ravenous hunger to understand how is it that people are driving Bentleys and Ferraris, and I go downtown and there's 80-story tall skyscrapers, and we don't have enough food in the fridge to get through 3 days. And, I was about 13 years old when I first figured out that we were really poor. Like we were buying food with food stamps, and we were getting handouts from the Mormon church. And it was one of those upbringings where there was a lot of fear around money, but that eventually created a lot of curiosity about money. And that put me on the path that eventually led me into real estate investing and where I am today. So in hindsight, super grateful for it. Going through it, I wouldn't wish that on very many people.
So very humble beginnings, but I think that fuels you. And I like to talk a little bit about people and their background before we get into who they serve, because it just shows that you have this chip on your shoulder, this fuel to have a back against the wall mentality, and you're just going to figure it out. And so you inspire us. We've already talked offline a bunch, but I want to get into two things. One, can you touch briefly on your real estate portfolio now, just to let people know like what you have as your investment portfolio? And then I want to talk about who you serve and what you do professionally.
Yeah. And maybe just to create a bridge there. So I'm in my early 20s, and my grandmother and my grandfather were actually very successful in real estate investing and owned apartment buildings and those types of things. And my grandmother said, listen to Robert Kiyosaki's Rich Dad, Poor Dad on your way down to my house for Thanksgiving, or don't show up. It's kind of one of those grandma ultimatums. And I remember listening to that book on tape at the time, and like understanding for the first time in my life, like a light bulb went off. Like, I get it. I understand what wealth is and how to get there one step at a time. It's not about having money. It's about holding assets that create cash flow and escaping the rat race and getting from the employee side of the cash flow quadrant to the big business owner, real estate investor quadrant. And it was like a totally different path illuminated itself in front of me. And I was like, I'm just going to do that for the next 20 years. You know what I mean? And so fast forward today, my mom and I started investing in real estate in 2000. So we're 25 years into this journey. And over the last 25 years, we built a little family office. We have a 9-figure real estate portfolio now, 23 commercial buildings, 170 plus tenants. And, the gross revenue from that business spins off about $6 million a year in gross revenue. Of course, there's a lot of expenses there, but we've grown a pretty cool real estate holding business. Everything from, getting started in single family homes and 100% financing from seller financing, because we didn't have a penny to our names at that point, to now scaling up into retail, industrial, flex, medical office buildings, et cetera.
Love it, man. So interesting how you became your way into like the mortgage business. And I want to talk about that now. You consider yourself, and this is how we've come to know you, as like a debt consultant. And there's people that help you be financial advisors. We teach people how to buy real estate, but a debt consultant is an interesting thing. I'm curious, from the outside perspective looking in, I want to talk about how you got to that point with the mortgage space, but then also like I hear this all the time. Aren't all lenders the same? Like isn't it all the same just going to mortgage lenders? Like they all do the same thing. Can you talk to us about what you would say to someone who says that?
Yeah, totally. Isn't it a 30-year fixed with cheese or a 15-year fixed with cheese? I mean, that's all mortgage lenders do. Let me take 2 steps back. So happy ending. My mom goes back to law school in her 50s, graduates with a law degree, and starts into landlord tenant law. So she starts serving landlords, protecting them against tenants and helping them with evictions, ends up doing asset protection, starts working with tons of real estate investors. And the real estate investors all tell her the same thing. I can't find anybody worth a salt in the mortgage business that knows how to handle my complicated tax returns and all my portfolios and all the things I'm doing with my investments. And I said, maybe I should get into mortgage. So that was 20 years ago. I get into mortgage. And my very first transaction was dealing with real estate investors, trying to decodify a very complicated financial situation. And what I've learned over the last 20 years is people think really clearly and intentionally in days, weeks, months, maybe even years. They think terribly in terms of decades and multiple decades. We're not educated in school to understand how to use leverage, how to use other people's money, how to structure indebtedness, not only so it's the lowest cost, but it creates the greatest amount of cash flow, which is the whole game. Cash flow gets you out of the rat race, which means you can play the game forever as soon as you have more cash flow than you have expenses. So we have created at Neo Home Loans a viewpoint, or we have taken the position of the liability advisor. You've got financial advisors who handle the asset side of the balance sheet, but nobody's really looking at the liability side and saying, well, you're selling a house, you have $400,000 in equity. Should you really be putting the whole $400,000 down, or should you be putting $200,000 down? Should you be getting rid of $100,000 in non-mortgage debt that just freed up $2,000 a month in cash flow? And should you take that other $100,000 and go buy another property, and that'll get you another $500 a month in cash flow? Like, how do we use this liquidity to create the greatest amount of cash flow? And that's liability side of the balance sheet management. And nobody else is doing that and helping people think not just what's my payment today, but what is the ramifications of these decisions in 10, 20, or 30 years?
I can attest to this because we have sent a number of our community members your way and a number of just people that we know in our network your way. And the level of detail and helping people not just plan out, well, what's going to happen with this loan product? It's like, well, how does this loan product affect my next, taking out my next loan? And how does this debt that I'm getting into affect taking out the ones 2, 3, 4 years down the line? And how can I build a great life for myself? That's essentially what we're talking about here, and make those decisions today affect the decisions or the life that you're going to have 5, 10 years from now. So I think it's awesome what you're doing. I guess to paint a little bit more picture before we dive into the product side of what you do is like, how did Neo Home Loans come to be? I mean, I know you're like helping to run this company right now. So like, what about the real estate investing side led you to here? And why is this the thing that you want to focus your time on, I guess is my question.
You're talking about why do I want to focus my time from the mortgage perspective in this area?
Yeah, exactly. Like what about this side of the business do you love?
Yeah. I love showing people things that they had not imagined or contemplated themselves. Like I'll give you an example. One of the things that comes up all the time in our, what we call a dreams and goals call, when we're doing basically an interview with a customer, that first conversation is, should we keep this current house or should we sell this house and use the cash to buy another one? And what I find in that example is that they're thinking in very short periods of time. And if I take the equity from this house and roll it into another house, that makes it more comfortable today, which is totally true, because you've got a $250,000 down payment to buy the next house. That's a lot more comfortable than maybe only having $50,000 to buy that next house. What they're not looking at is, what are the consequences of both decisions over 30 years? Because when you get to retirement, the only thing that's going to matter is how comfortable you are and how much cash flow you have. And most people aren't connecting today's decision to how to use their liquidity from a property that they're selling. They're not connecting that to, how does this impact my cash flow in 30 years from now? So to answer your question, like, when we can step back and look at a scenario, I had a great coach one time that said, it's really hard to see the picture frame when you're in the picture. But when somebody steps back and looks down at the scenario and gives you a totally different idea of what it looks like, and in most time what that means is 10, 20, 30 years down the road, which you're not thinking about. You're just thinking about what's the comfortable decision today. And you see the light bulb go off in their head, and they're like, holy shit, I did not think about that ramification. That's what I love about this business. You give somebody something that help them arrive at a conclusion, or at least give them the information so that the light bulb goes off and they potentially pick a better path for themselves.
What really drew me into not only just Neo, but you, Josh, is like how you guys really treat your client base. And it's a deep dive. And I'm kind of just saying what you said again, but just like reinforcing it, because to me, we went through one of these calls, and what's really cool to me is like, you not only specialize with self-employed clients, investors, business owners, it makes you feel like you found the right people. And I say that like a lot of times you go to a mortgage advisor, right? I wouldn't even consider them a consultant had I not talked to you, but like, we go in and you have a conversation and it's pretty cookie cutter. And then you go through it and you're like, okay, what's my rate? But with you, we had this deep dive conversation. We went through, and you know what I loved? You mentioned a liability advisor, and it just stuck with me because I have a financial advisor, right? And I'm like, you don't, and that's, I think of as like an asset advisor, right? Versus the liability side of things. I'm like, yeah. I've never even thought of it. Like, I manage this myself, but we took a look at the entire financial picture. We went through different modules to see how would keeping this property as a rental property impact my decision 5 years from now, 10 years from now, 15 years from now. And what we netted out was, we were debating, and long story short, I'm buying the new primary residence, and I was debating keeping my current home as an investment property. And in my head, I'm like, I'm keeping it as doing anything I can to keep this as a rental property. And we went through, and you reinforced it with numbers. I would have taken a $1.5 million loss if I sold that property. And that, to me, I'm like, no one does that. And we went through a bunch of different scenarios. And what I also found was that you can pull HELOCs off of investment properties, and you have a lot of different products and things that really speak to people in Corey and I's shoes. And I think that's what we want to talk through in a couple of minutes here, is like really like who you serve, but then also the products that people aren't even thinking about. And I hate using it as a product, but I think it's just like a lane of resource for you, or something to help you along the way that you never even thought about. We're taught mantra after mantra, like, hey, what after your 10th mortgage, you're going to have to look elsewhere because you're no longer lendable. And then another side of things is, you can't take a HELOC ever out on an investment property. You debunked both of those in our conversation. And I just think about, it's so important. You don't know what's out there. So I guess this is me just shining a little light onto, hey, you helped me out personally. This was awesome conversation. And I think maybe taking a little bit deeper of a dive for people to understand, you need to take into consideration thinking in decades, but also laying out your whole financial picture. This one decision you make with your loan is going to impact you and your family from years down the line. So I don't know if you have anything to build on that, but those were my thoughts. And like, I really see that your avatar, and you correct me if I'm wrong, but it seems like it's investors, self-employed people, small business owners, and people that are like on the next stage, like taking down multiple deals.
That's exactly right. And first of all, thanks for sharing your story with me, and giving me permission to, give you some ideas and just like that outside perspective. So thank you for that. I think the reason why you feel a difference when you work with our group is because everybody on our lending team owns investment properties. They have side hustle businesses. They are entrepreneurs at heart. And most of the people on my team have been with me 10 or 15 years. So we have investments together. We're challenging each other all the time with our own financial decisions. Is this an emotional decision, or is this an intellectual 20 or 30 year strategic decision? Are we playing checkers, or are we playing chess here? Right? So we have that internal kind of competitive, fun culture where we trying to up level each other. And so there's no bigger high five, like, the one-handed grab in the back of the end zone to win the Super Bowl is when somebody comes into the office and we're all sharing our wins and we're like, somebody thought they were going to do this, and I showed them this, and if they follow this path, they're going to be $3 million more wealthy. Like, that is the biggest win in the freaking world when you can illuminate that different path for somebody. So that's just kind of a little bit of insight in the culture that we have. And then as a result of that, our frequency of working with self-employed folks, people who are having challenges getting financing, even W-2 folks who have rental properties and complicated tax structures, and, oh yeah, but there's actually a private money note over to a relative here. Like, all of that web that you build when you're building a real estate empire, the frequency of us dealing with those types of folks is probably 10x what most mortgage people do. So we have brought together a suite of products, which is what Ryan was alluding to, a suite of mortgage products that overcomes 90% of the problems that most people have when they go into a conventional world or walk into their local bank or credit union, and the eyes get big and they're like, I don't even know how to digest your tax returns. Your schedule of real estate doesn't fit on our form. We'll get back to you in a couple of months with an answer, right? So we're used to that frequency of customer and deal with it all the time. So I think that the level of service and the products we have has evolved with our customer.
Yeah, I think that's the thing that I want to hone in on here, because there's like a funny internet thing that I've seen. It's just like a post on Instagram, like, business owner takes home $350,000 a year for the past 3 years. Bank, no. W-2 employee, 75K stamped. Yes, here's your loan. And I'm now your case study, as Ryan is. Ryan still is working the W-2 job, but I left mine about 15 months ago, and I'm thinking, man, how long is it going to take me to be able to be bankable, to buy a primary residence? I'm buying real estate creatively. Like, that area is fine, going to off-market deals, but like, I don't know how I'm going to like show the banks that I'm bankable, and a product or a company like Neo has made it so much easier. So like, talk to us about some of those. Maybe if you want to bring up a couple products that people aren't even aware of, and this would help us like tell the story to that business owner that's listening.
Yeah, and I'll share a visual, but I know many people are listening to this in the car or on a podcast rather than watching it on YouTube. So I'll make sure I describe these. You see my screen okay, Corey?
Yeah.
Okay, great. So essentially, and we could get more nuanced than this, but let's just talk big picture. There's basically 4 different buckets of loans that real estate investors should be educated on, and self-employed folks. If you have sophisticated tax returns with multiple real assets, you should know these different products, okay? So the first one is conventional loans. And if you've ever been declined for a loan before, it was probably a conventional loan because your square didn't fit the round hole, right? Entrepreneurs are built different. Let me just give you some quick breakdown here. Your income on a conventional loan is documented by tax returns and W-2s. You need a full tax package, 2 years, all the stuff, full financial oscopy to qualify for that loan. Your minimum down payment is typically 20%. You could actually do 15% on a conventional loan, but the rate sucks so bad with the loan level pricing adjustments that it really doesn't make sense from a cash flow perspective. You're limited on your loan limits to conforming loans. So if you're buying a second home or a nightly rental in a vacation area, oftentimes conventional won't work because of the loan limits. And really, the conventional loan is best for a W-2 employee who's picking up their first couple of rental properties. And if that's the bucket that you fall into, great. It's a decent solution. But a lot of people, especially as they get further into their either self-employed journey or their investor journey, it gets harder and harder and harder to do conventional lending. Not to mention, you can only have 10 financed properties with conventional loans. The second bucket is and feel free to jump in if you have questions. The second bucket is a DSCR, debt service coverage ratio. The rental property and the cash flow from that rental property is how you're verifying income. It's all more like a commercial loan. It's all about the property and less about the borrower in terms of an income. The documentation, we're either going to show a lease agreement on that property that you're buying or refinancing, or if it's currently owner occupied, you're going to buy it and turn it into an investment property. Then we can use what's called an operating income and comparable rental schedule that comes from an appraiser. They're going to say, here's what the income is, here's what the expenses are. That's the factor you could use to offset your mortgage. Down payments are typically in the 20 to 25% range. And that's because typically once you look at rents and then you factor in an expense ratio, like normally you're going to need to get to 20 to 25% down, depending on the market you're in order to get enough income to offset the mortgage payment on a debt service coverage ratio loan. There are exceptions where you're buying something in a very low price to rent area and you can do higher leverage, but general rule of thumb, loan limits up to 5 million. So this is great for somebody who's, like I live in Park City, Utah. The median home price in Park City, Utah is like $3 million, right? So that's a starter nightly rental home is $2 or $3 million. So this would be a great product for that. And this product's best for rental property investors. The third bucket is a bank statement loan. So Corey, for you, we would never, we're not going to look at your tax returns or your W-2s because you're newly self-employed. We would look at your business bank statement deposits for the last 12 months or your personal bank statement deposits for the last 12 months. So you're using bank statements only to qualify. You can do as little as 10% down. There's no mortgage insurance, which is a plus. Loan amounts up to 4 million. Best for self-employed or 1099 income individuals. And then the last bucket is an asset-based mortgage. So we're actually going to use asset statements. We're going to look at the net liquidity you have between stocks, bonds, checking, savings, etc. We're going to divide that by 120 months. So if you have $1 million, you divide it by 120 months, you're going to have $8,000 a month in income. And that's the income that we can utilize on as an income factor rather than using tax returns. 10% down, loan amounts up to 4 million. Great for investors with assets. Whew, let me take a breath for a minute and answer questions.
Yeah, no, that was awesome. So, I mean, the way that I'm looking at it, Josh, is that Neo is solving problems for the end user that a lot of lenders aren't even thinking about. And, this happened in a situation, my sister, for example, this was before we even came in contact her. I would have just sent her to you. She ended up working out, but she's an influencer. That's what she does. So she gets paid, and she gets paid very well from brands, right? But she's not looking good on paper to a bank. So it was a struggle for her to get her first property, which actually was not a primary residence. It was a property in the Catskills where it's like a second home. They live in Brooklyn. They're going to go up there. They're going to rent it out on Airbnb. And I just remember the process for her. And she was like, am I missing something? Like, I'm not going to say how much she makes, but it's not a little. why am I having issues getting this? Like I make a great living. So I think that for anybody that, even if you have a side hustle or you're a real estate agent or you're something of that nature, you're not looked at by the banks like super favorably. And this is something that you have to take a look at because it can be a lot simpler than you think. You don't just want to listen to people that are like, oh, I can't get a loan, or else, you're not going to be able to pursue those things. So, that's amazing. One of the questions that I wanted to ask you about is we had a podcast episode. I don't know the order of when this is coming out, but it was recently where we talked about the 50-year mortgage. And Ryan and I gave our opinions, but we're not liabilities consultants. We're just sharing our story of what we know. So I want to hear your take on this. Kind of all it is an idea right now, but I want to hear your take because I think it's actually potentially different than what we think about it. And that's good. We want more perspectives, and you've been in this game longer. So tell us what, I know this is something that Trump proposed. Who knows if it's going to come to effect, but what are your thoughts on the 50-year?
Yeah. And I want to make this conversation timeless. So whether 50-year mortgage manifests or doesn't manifest, the lesson that I am trying to teach through analyzing the efficacy of a 50-year mortgage is going to be timeless knowledge for people to understand. So again, I'm going to share a screen here, and you guys see the 30-year versus 50-year mortgage analysis?
We do.
Okay, cool. And I'll narrate through this for everybody, but let me give you the setup. What I did is I ran a 30-year mortgage scenario versus a 50-year mortgage scenario over 50 years. And it's a median home price in the US right now is $415,000. I showed 10% down. Here's our loan amount. I factored in a 50-year rate at a 0.25% higher interest rate than the 30-year. So I used 6.3 for a 30, 6.55 for a 50. We showed principal interest. Obviously, the principal and interest is fixed for the entire year, but taxes and insurance grow 4% per year. This was one hell of a math equation to work out over 50 years, by the way, guys. So we factored in 1.51% for escrows. Each year over 50 years, assuming the home is growing at 4% appreciation each year. We also went to Zillow and found the median household single family rent in America right now is $22.45 a year. We factored in rent increases of 4% a year, and we assumed that the person was going to live in the home for the first 10 years, and then rather than selling it, they're going to keep it as a rental property long term. So rent income doesn't begin until year 11. Now, in the case that the person never moved, because some people don't, they just stay in the homes forever, we also factored in that they had a median household income of $100,000, which is about the median household income in Utah. And we factored in a 4% income growth over the next 30 years. Because what we're going to talk about right now is inflation. Inflation pushes up the price of the home. It pushes up the rents that you can earn if you decide to rent out the home, and it pushes up your income. And what people aren't focusing on, they're only thinking about the additional cost. They're not thinking about the power of inflation over very long periods of time. And guys, the only reason I think this way is because I still own the 8-plex that I bought in 2001, and I've seen my rents go from $300 a month per unit to $1,700 a month per unit. So when you've seen your rents almost 6x in 24 years, you start thinking really long term. So I know there's a lot of numbers. I'll narrate my way through this. On the left-hand column, you've got the top section is a 30-year mortgage, and I broke it down in year 1, year 5, year 10, year 20, year 30, year 40, year 50. Same exact thing for the 50-year mortgage down below. We've charted the property value over that period of time, and it's the same property value for if you do a 30-year mortgage or a 50-year mortgage. For those of you that are listening in, at year 50, with 4% appreciation, that $415,000 house is worth $2.95 million. And you're going to go, what? But if you go back to 1971, the average median price of a single family home was around $20,000. Today it's $415,000. So, given a long enough time horizon, that's what inflation does to the value of properties. Now, on the 30-year mortgage, I showed the mortgage balance going down over 30 years. So at year 30, it's paid off. On the 50-year analysis, I show the mortgage balance going down slower, and it's not paid off till year 50. Then I showed your amount of equity, and you can see this is the equity at this timeline. So at year 20, you've got $704,000 in equity in the 30-year. On the 50-year mortgage, you only have $577,000 in equity. So you're less wealthy at that point. Total interest over 30 years would have been $459,000 on a 30, $898,000 on a 50. So granted, the interest is double. You are paying on it for a lot longer period of time. And then I factored in your principal, interest, taxes, and insurance. And you'll notice that these payments go up, guys. That's because I'm factoring the 4% increase in the property value, which means your taxes and insurance also go up by 4% per year. And when you're talking about over 50 years, in year 50, you have $3,700 a month. Just in escrows there. Your monthly rental income, you have, so this is showing the 2245 growing at 4% per year. And we're assuming there's no cash flow for the first 10 years because they're living in the home. And then in year 11 through year 20, they have $85,000 a month in cash flow. Their PIT payment would be $34.57. Their monthly rental income would be $47.30. I'm not factoring in expenses. This isn't a case study of a specific analysis on an investment. I'm just trying to show side by side the efficacy of going with a 50-year loan if that's the only way into a property for you. But by year 50, you have $2,316,000 in cash flow in the 30-year scenario. And you have $2.95 million in equity, meaning that your net worth increase between those two numbers, you made $5.2 million. That's pretty bitchin'. But what if you couldn't afford a 30-year mortgage? What if a 30-year mortgage puts you into a much worse neighborhood that would have lower tenant quality, less appreciation, doesn't fit your family, or perhaps you needed to wait 3 or 4 more years to save up more down payment to get the home that you want, leaving you in the rental market? And what if the only option was to do a 50-year to get in the area you wanted now versus several years in the future? Let's do this same analysis. Yes, you pay more in interest, $898,000 in interest, but you still have $2.95 million in equity at the end of 50 years. And your cumulative cash flow was $1.85 million. So you still made $4.8 million more, or $4.8 million more than if you would have rented. And the point that I'm trying to make here is over time, these rents increase. So at year 10, you're barely cash flow positive. You're $300 a month cash flow positive. But at year 20, now you're $1,500 a month cash flow positive. And this rent number just continues to increase and increase and increase over time. One last thing I just added on here just for fun, guys, because we've talked a lot about how inflation destroys debt. Let's say somebody didn't rent the property out. Let's say they stayed in the property the whole time. Well, to start out, let's just look at the 50-year here. If they had $100,000 a year in income, that's $83.33 a month. To begin their mortgage in year one, 32% of their income would have went to this payment. So 32% of $83.33 monthly income is their starting payment of $26.43. But over time, as inflation pushes up their income, calculating 4% increases per year, you go from a 32% debt to income ratio. Year 20, you're only at 18% going towards your mortgage payment. Year 30, 14%. Year 30, 14%. Year 40, 12%. Year 50, 10%. So my point is, if you didn't love this 50-year mortgage and you wanted to cut down this interest, as your debt to income ratio is going down, you could easily attribute more money towards paying down the principal, or you just save that extra money and you buy your next investment property. So just to close this out, if it makes the difference between you getting into a home or renting, or if it makes the difference from you buying in a crappy neighborhood that you don't feel safe to move your family into the school districts in a decent neighborhood, don't throw the baby out with the bathwater. You still made $4.8 million on this property over 50 years.
So that is exactly what I wanted to highlight. And if you're following this, probably a little hard to follow if you're driving, but if you're on YouTube, you can easily follow along. And Josh broke it down pretty well with the numbers here. But basically, the moral of the story is that if you can afford a 30-year mortgage, you definitely want to go with that option, right? Totally. You wouldn't want to forfeit a 30-year mortgage to go with the 50-year mortgage just to save a little money if it wasn't a deal breaker for you. However, if a 50-year mortgage allows you to get qualified to get into this property and your plan is to hold on to it long enough, you definitely want to get into a 50-year mortgage instead of not doing it at all, because all somebody needs, and I know 50 years is a long time, so $5 million in 50 years is not going to be what $5 million is today. But if this is your primary way or your only way of building wealth, which doesn't have to be, but for some people, I would say, don't quote me on stats, majority of people, the majority of their net worth is in their primary residence, right? At least is certain stages of their life. Now, this is not maybe savvy investors, but just if you buy a couple properties and you hold on, you're going to be pretty wealthy. So I think this is important for people to note that, Josh, you brought a new kind of perspective where Ryan and I wouldn't say we were shitting on the 50-year mortgage, but we were saying is a short-term fix for a long-term problem. That's kind of like the way that I was looking at it. But if you're able to get into a better neighborhood and a property that's going to appreciate a little bit, maybe even more than the 4%, then it sounds like a great way to help some of the people who wouldn't be able to be able to qualify for a loan. So that's important to note.
And one more thing I would add for this, because again, I think I have a unique perspective in that I own 5 multi-unit apartment buildings that I've owned more than 15 years. I've refinanced every single one of those buildings 2 to 4 times. So the reality is nobody's going to it's highly unlikely that if you take a 50-year mortgage today, you're going to have that 50-year mortgage in 2075. There's going to be multiple opportunities throughout that mortgage or throughout that loan where interest rates dip. We just showed your income went from 100,000 to like 400,000 over that period of time. And now you're like, okay, why don't we just get rid of this thing? Let's refinance and hit a 15-year and just knock this thing out, right? So all I'm saying is I'm not trying to pitch people 50 years and convince them to do it. I'm just saying don't throw the baby out with the bathwater. Think through the long-term wealth prospects if this is your only exit into the investor freeway or entrance to the investor freeway.
You nailed it. That was a perfect tee up, because that was my next question to you, because we talked a lot about this, but like as investors, you reposition your asset allocation all the time. We've seen waves of capital come in to different vehicles and different assets that you're like, hey, I need a sliver of that, right? But I think people forget to do this with their real estate portfolio, and they just get the loan and they're like, hey, I'm going to sit on this forever. Corey and I, we bought our primary residences and then eventually converted them into investment properties. But within that cycle, we refinanced during COVID when rates went down to sub 3 or even 2.9%. I think Corey might have on one of his. But my point is, you really have to learn the game to understand that this game goes in cycles, right? But to have someone, that's my personal take here, is to have someone in your corner that's a liability advisor is so key, because now I'm able to say, okay, Josh, this is great. Here's an outlay of my entire landscape. Here's all the assets I have. Here's the 401k. Here's the Roth. Here's my whole financial picture. I'm comfortable at this point sharing that information with you, because I know if I pull one of these levers and sell off one of these properties, or I convert it to a rental property, or I need to free up some cash flow, or I have the huge equity play coming in where I'm going to sell a property. I have $100,000 coming in. What do I do with this? I want to make sure that I'm pulling the right levers for the 10, 15, 20, 30 years down the line. And most people don't think this way. So I'm wondering if you can kind of shed a little bit of light, how often do you meet with clients to have conversations like this? Like once they're in the neosphere, is this something where it's kind of like a financial advisor where you meet quarterly or yearly? How do you guys really like handle it? Because I'm thinking it more of as like a CPA to my financial advisor, like just another person that I need on my team to meet with and kind of steer me in the right direction.
Great question. So 2 things that we do. The week after closing any loan, we're going to get on a phone call and go, okay, do you remember who you pay when and when your first payment is? Because I know you just moved 117 boxes and all the stress of closing and all the things. And we do a post-closing call. On that post-closing call, we want to make sure everything is set up. There's no questions. We're good. The training wheels are off and you're flying. One of the things we do is we set a strike rate. So we're going to decide on that call the interest rate at which it makes irrefutable sense to restructure that mortgage indebtedness to a lower cost. Because here's what happens with interest rates. We may have a window of literally 4 hours, because interest rates are controlled by the bond market, and they can be as wild and fluctuating as Bitcoin or the stock market. They can be all over the place. So if we close your loan at 6.75, we're going to decide, does it make sense based on the size of your loan and your goals to refinance at 6.25? Is it 6? Is it 5.75? Here's how much that refinance at those different levels would save you over 5, 10, 15 years, depending how long you're going to be in the home. And you're going to go 6%. If we can go from 6.75 to 6, I understand the costs are going to be a couple $1,000s for title fees and an appraisal. That's a game changer for me. I would do that loan. Cool. We're going to set that strike rate in our software so that the minute when rates hit 6%, I'm not calling you back up and being like, hey, do you still want to refi at 6%? We've made that decision. I'm locking that loan for those clients. And we'll have days where we'll have 20 or 30 strike rates go off in a day. There is no way in God's green earth to have 30 conversations. You have time to lock 30 loans, but if those rates are higher tomorrow and you only talk to 3 people, you just screwed 27 clients who you didn't get locked. So that's the first thing we do. We set a strike rate, we agree on it, and we execute when that interest rate goes down. So you don't have to be watching mortgage markets and thinking about when to refinance, like you're off with your life. Second thing we do is we have someone on our team called a client success manager. That client success manager is following up with our clients at least once a year, typically on the anniversary of their mortgage. And they're following up on things that happened in the conversation. Did you ever get your LLC set up? Did you ever meet with an estate planner? Did you ever get a second opinion on the CPA who you said drives you crazy, right? And did you ever meet with a financial advisor? Are you still considering buying real estate? They're going to kind of go through this like financial checklist that we initially go through on our Dreams and Goals call. And then they're going to loop you back with me and say, Ryan's ready. He's ready to do his estate. It's time to make the introduction to API law or whoever we're going to recommend to set up the estate. So those are the 2 primary check-ins. One's annual, and the first is to set the strike rate.
Perfect. It's really interesting. So you mentioned Strike, and that's just a company I love that I use for all my Bitcoin stuff, but also a strike rate. I never heard of that before, but it's just a limit order. That's all you're doing. You're setting the exact amount that, hey, this is my buy price, right? So I didn't even know you could do that on the mortgage side.
Yeah, Bitcoin goes to 50,000. How much do you want, right? You've got an order in there. We're doing the same thing in an interest rate, right? And it's either a strike rate or a strike payment. What payment justifies this refinance, or what rate would you be excited about for us to lock and move forward on? And we agree with that up front.
I can't highlight how important that is, because people get so busy and you're not thinking about your mortgage rate on a daily basis or anything. Like really, I'm not thinking about the Bitcoin price while it's 3 a.m. and I'm sleeping, but if it hits my number, I'm getting that direct deposit dropped in. So that's amazing. I think that's something that, we kind of went over, but I think that's a lane where people are like, just knowing you're taken care of and you agree on the price. It's an auto buy, which I love. So also taking it back to, say someone just starts to work with you guys. I know you mentioned that initial call. Can you talk about the intake of like, hey, what information you need from people, how you kind of break it down, and then talk to me about the modules and the AI software that you guys use, because I know we went through that and it was really cool to see a bunch of different scenarios where I have never gotten that before when I've talked with a mortgage advisor, and I felt like I had multiple options instead of just one.
Yeah, well, let's talk about, if it's okay, the interaction that you and I had, where you were kind of telling me about the scenario as you described earlier. And I think most mortgage folks would have started asking you about the new home that you're going to buy and started quoting you rates, right? That would have been the direction they would have been. I was like, whoa. Forget that for a minute. What are you doing with your current asset? And let's make sure that decision, because that decision dictates what you're going to do with the new acquisition. So let's make sure we have the strategy right before we even ever get into any mortgage scenarios. So we're going to ask more questions, and we're going to try to, not only see the picture, but the frame around it and understand where somebody's going. And to some people, it feels a little awkward. Like we've had people many times be like, why are you asking me this question? Like, aren't you doing mortgage? And I'm like, yeah, but I need to understand the story behind the story to make sure I'm giving you the right advice. Our slogan internally is great advice is always more valuable than the lowest rate. Always. Because I can show somebody how to make another $1 million in strategy. I can save somebody $27 with the lowest rate, right? $27 a month. So we're going to ask deeper questions around that. And then we're going to try to paint different scenarios. The presentation that you are talking about, I actually had my partner Ross create one. And I'll bring that up for you right now. So this is this is what's called the total cost analysis. So this happens to have the 4 options that I shared earlier: your conventional, your debt service coverage ratio, your bank statement, and your asset depletion. And this is just an example, right? Like, this would be unusual that we would show these 4 options. Many times we'll say, hey, here's what conventional looks like. Here's what debt service coverage ratio looks like. And here's what 10, 15, 20, and 25% looks like. And then you can compare the cash to close, the payments, and the amount of wealth these strategies are going to build over your estimated time horizon of ownership. So in this scenario, right, we've got our 20% down. And I think this is actually pretty good for people to see. Right now, your debt service coverage ratio loan on investment properties is lower than a conventional loan. And of course, this is a conventional non-owner occupied. There's no points here. So many times loans will come with, 2 or 3 points up front so that the rate will look lower, but you had an extra $15,000 in closing costs you got to bring to the table. So these scenarios are no point options. And it shows you that the DSCR loan is more than 0.5% lower. You're in the mid 6s versus the low 7s on a conventional. But this is just an illustration of how we show multiple different mortgage strategies. And then we show them what's the payment difference, right? So the conventional is the highest payment option. Each of these options would save this amount of money per month. And then we show them what's the difference in costs over 15 years. That's assuming the person was going to be in thought they were going to keep this asset for 15 years. If they only thought it was 5 years, we change it to 5 years. And then we show them how much equity they're going to build underneath each strategy. And obviously these are all the same because this is a 30-year loan. And at the end of 30 years, the mortgage is going to be paid off. But if the time horizon was 10 years, then you'd be able to judge like which one of these options has the most amount of money going towards principal, which is going to net me the biggest check when I show up at the attorney or title office to sell this property in 10 years. So this is the level of comparison and analysis and advice that we give on the buy side.
Yeah, I love it. I have a million questions for you. I just have this sense of not only pride, but like comfort to know that I have someone like this in my corner now. And obviously specifically it is you guys that you're amazing, but I didn't even know this was out there because we talk about this and we go through the process of telling people to build their team out. And I've kind of almost like throughout the years, I've kind of glossed over how important a mortgage lender is. I understand that you need one. And I always understand that you need one as a process oriented thing to happen before you get a loan. But I now think about it as you're just like a sidekick to my financial advisor because I need to know that the liability side is covered. Any situation happens, not only in the market, but in my life. And then I can go to you guys and say, hey, listen, this amount of cash is coming in. Do you think I need to change anything on my landscape here in the next 2-3 years? Do we need to do a refinance? Do we need to do a cash out? Should I sell this property? Just really running the analysis. And it's so helpful. I think you mentioned that like the being honest about finances. And I think people are so afraid to admit certain things and say this, and they like hold back that they have this cash squirreled away or that they're actually in debt. And when you have conversations with you, I'm like, why would you ever hold that back? It's only going to hurt you from not putting it all up front. So I'm more of like, lay it on the line. Let's really dissect this thing. there's two things that really changed, or really one thing that I want to talk about that changed kind of the trajectory for Corey and I, and was finding out about HELOCs, home equity lines of credit, and realizing, hey, you can stack up a bunch of equity over time. And we always talk about the benefits of real estate investing, but stacking equity in your property and having it appreciate over time, but then being able to tap into that to multiply your portfolio or invest in other things has truly set us apart. We had someone on our podcast, maybe, year 2. I forget the gentleman's name. I think his name was Marquise, but he mentioned to us, he built his portfolio of 10 units at the time, just based off of HELOCs. And Corey and I were like, well, we've had our primaries for a while. Like, let's dive in. We got HELOCs out. We ended up buying more property from it. My point is, can you talk to us about the benefits of a HELOC? And can you talk to us about how you would get one on an investment property versus only your primary residence? Because I had always thought it was only your primary that you could pull from.
Yeah. And before we get into that, let me just frame something up that you just said around that podcast episode. Like, if you look at dynasty families who have wealth through multiple, just, you're talking like the Rothschilds and those types, and the Carnegies and those types of families, what is different between, one of the things that's different between them and how most people act is, when they need cash, they don't sell off their assets. They leverage their assets. They say, I'm going to give a percentage of my cash flow from this asset, and I'm going to trade that for liquidity in the form of a line of credit that I'm going to go use to control more assets. Most people that aren't, dynasty, legacy, wealth thinkers, multi-generational thinkers, say, I need 75 grand in a hurry. I'm going to sell this rental property so I can get that 75 grand. So that is a very different mindset that people should at least consider. So this is an ugly screen. I'm going to hit it high level, because the point of me showing all these options are, we have 6 different home equity line of credit products that are available for primary residences, second homes, and investment properties. Home equity lines up to $750,000 is very common amongst these products. We actually have a cash out product for super high end properties that would enable you to do a first and second mortgage up to $5 million cash out. So if somebody's got a paid off massive vacation rental property, that's pretty stupendous. The lines of credits will go 95% of the value of the property on a primary residence. So if you have a $500,000 house, you only have to leave 5% in equity, which is 25 grand, which means you could leverage all the way up to 475,000 in that house. So if you got a $300,000 first, you could pull out a $175,000 line of credit. And the beautiful thing about a line of credit is you don't pay interest on it until you use the money. So if you just want to have liquidity available in case you find the perfect property, you can do that and you don't have to pay interest on it. Or you could buy the property. If you end up selling the property, you could pay the line down. It's revolving. 90% loan to value on second homes and 80% loan to value on non-owner occupied. These loans go down to 640 credit scores, so you don't have to have perfect credit. You're not getting a 95% loan to value with a 640. Spoiler alert. But there are lines of credit available. And you don't have to be the cookie cutter W-2 borrower. You can do full doc, which would be tax returns and W-2s. You can do personal bank statements. You can do P&L loans. You can do debt service coverage ratio. So there's all kinds of creative ways to document income there.
Love it. Well, let me just we could go on for hours here, but I just want to break this down for people. This is why when people say there are levels to this game, and I don't mean levels of education. I just mean levels of how do you want your transaction to be taken care of, right? And there are people out there in the mortgage business, in every business, in roofing, in lending, in agents that are transactional. I got to get to the next dollar. Let me get to the next dollar. No matter what, I'll get you a lower rate. Let's go. Let's move. That's how a lot of people think. And now if you want to create relationships for life or for the entirety of the time that you're doing business, you have to have somebody on your team that understands you and your personal picture. So that's why you're asking these deeper, higher level questions to these people. So I think that if you're willing to take a deep dive, anybody listening to this podcast episode should book a call with Josh and Ross and their team. And they lend everywhere. I don't think there's anybody that shouldn't at least understand their debt picture if they're looking to continue to buy real estate. We did it. Ryan got incredible advice about a primary residence, which is something that you would think is simple. It's not that simple based on his scenario. And now it became more simple after this conversation. So for us, I'm going to run every situation by you guys in the future. Hey, I'm looking at this. There's no guarantee that we're going to work together on every single loan in the future. But if I have somebody in my back pocket more often than not, why would I not go down that road? So Ryan, I didn't have anything else here. I wanted to make sure this was succinct enough. Josh probably needs like a take 30 here after all that talking. So yeah.
I need a cold plunge, Corey.
You do need a cold plunge, and maybe that's why we're drawn to you, dude. We just think and do the same things that we do. But one thing that I would do want to say, you can click the link in the show notes and book a call with Josh and his team, and we'll leave it there for you guys, and you'll get that consultation on the house, and really just get a breakdown of what Neil can do to serve you, essentially. And you might not be thinking about your financial picture or your liability picture actually in the right way. So definitely book a call. Josh, question for you. Just before we wrap the show, did we miss anything that you think is super important for, aspiring real estate investors that are, kind of taking deal 2 through 10 down or even beyond? I think that's kind of a loaded question. I just want to make sure we don't miss anything in the time that we have, because you are a wealth of knowledge and I don't want to miss anything.
Thanks. I really appreciate the kind words. The only other thing that I would see that investors are using very frequently that we didn't cover or are in need of very frequently is bridge and renovation lending. So oftentimes you're selling a property in North Carolina or in California, you're buying a property in North Carolina, but you find the North Carolina property before you sell the California property, and there's 3 offers on North Carolina, and there's no way they're taking a contingent offer. A bridge loan enables you to put a temporary loan, they're usually 6 to 12 month loans, on the property that you plan to sell, and you lock up that equity, enabling you to 100% finance the property in North Carolina. Then when you sell California property, you can pay down the loan that's on the 100% financing that you did on the North Carolina property. And this can be done, like we had a client the other day who sold 1 property in California and bought 5 properties across the country because he was selling a multi-million-dollar property and 1031 exchanging into a higher rent, lower price area. And we did 1 bridge loan. He collateralized his California home and bought 5 properties, and we closed those in 3 weeks. So, he was able to move faster than anybody else who had financing, didn't have to sell that departing residence. You can also do renovation with those. So let's say you go to buy a house and it's in shambles. Like you love it, right area, everything you wanted, but it needs 250 grand. You can't even get conventional financing on it. It's not livable. You could do a bridge loan where you collateralize your departing residence, use renovation funds to fix this property up, and then refinance the new property to pay off the bridge loan against the old property. So if you're running into challenges from either moving equity, you can't move equity that fast, or you're buying an unfinanceable home, you should think bridge or renovation or a combination of both.
So just on an elementary level, can you break down the bridge loan? Because that was like, hey, we're level 10. So I just want to have it clear for people exactly like what it means to take out that loan product and, kind of how they have to pay back and all that.
Totally. So let's say the house in California is $1 million value and you owe $500,000 on it. So you got $500,000 in equity, and you're buying a home in North Carolina for $500,000. And your plan is just to, sell this house and basically pay cash for North Carolina. But North Carolina has multiple offers on it. So a bridge loan would give you $500,000 in cash to buy North Carolina. So you'd 100% finance the North Carolina home. But instead of just putting a mortgage on the North Carolina home, they're going to put a mortgage on both homes. So the lender has collateral of $500,000 in equity over here, and they're only giving you a $500,000 loan for North Carolina. So they've got plenty of collateral, and it just enables you to 100% finance without selling another home. And this works for investment properties, second homes, primary residences. You can do it on any property type.
Wow. And so with the California home, do you have to sell that property to pay back that 500K, or can you just keep it and slowly pay it?
Great question. There's short-term loans, usually 6 to 12 months. So you need to pay that off in 6 to 12 months, but you don't have to sell California to do it. Let's say you're coming into a windfall of selling a business that you own, or let's say that you are getting a gift from a family or inheritance, or let's say that you're going to improve the value of the North Carolina property and you've got cash to do that. And now you're going to run that value of North Carolina from 500,000 to 750. Cool. Just refinance North Carolina, that 500 grand, pay off the bridge loan. California never has to be sold. So yes, you have to pay off the bridge loan, but no, you don't have to sell off the property that you're cross collateralizing it with.
Amazing. Thanks for the breakdown. That was perfect.
Yeah. Great
Love it.
solution.
Yeah, this is, I mean, the thing, it just goes on and on and on, the amount of options, and you don't realize that unless you have somebody like this kind of by your side. So Josh, if, we have the link actually to book if somebody wants to book a call with you, which I think is perfect, go do that if you're listening. For just like your purposes, following you, social media, networking, like what's the best way for people to get in touch with you?
Yeah, for sure. You can email me at josh@joshmettle.com. I'm on Instagram. I'm the only Josh Mettle that I've been able to find on Instagram, so you can find me there. And I guess like closing thought and something that I just want people to be thinking through is, the 7 favorite words in the English language for us is, I was just declined by my bank. So if you're an investor or you're a self-employed entrepreneur and somebody has told you no, we're excited to talk to you. Like that is the client that we want to serve and literally knock the leather off the ball when we are able to find a solution for you. So if someone else has said no, give us a call. Let us see if we can find a solution for you.
So
Josh, you rock. I think that's perfect. I'm sure we'll be seeing you again. We have some plans to chat in the future. And Corey, I don't know if I missed anything.
no, I just want to say that we value your relationship. We have been developing this relationship over the past several months. And, I don't think we've ever had anybody on the podcast twice in like such a short period of time, but we had to do a round 2. And I'm appreciative to have you in my corner. So thank you so much for joining us today. And, we appreciate your time.
Appreciate you guys. Grateful for the relationship and look forward to serving your community.